Right now, the Australian dollar is sitting on a level that has defined every major turn for the last 18 months. The 200-day moving average, 0.6895. And the entire market is positioned for a collapse. But here's what nobody is telling you. That very positioning has created a trap that could liquidate late shorts in a single session. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end, because I'm giving you 3 exact levels you can trade today. I am not giving you a report. I'm giving you my personal trade map, the same one I used when I was running an institutional desk. Let's get into it. The instant verdict on Australian dollar to US dollar this session is brutally clear. We are in a strong sell trend across every time frame from the 60-minute up to the weekly, but we are at a structural flaw that forces a decision. The bias is not simply bearish. The bias is that we are at a breaking point. I'm fading extremes and waiting for the trap to spring. The single invalidation level that flips the entire structure is 0.6870. Write this number down. If we break and hold below 0.6870 on a 4-hour close today, the bottom falls out, the 200-day moving average fails, and the entire structure resets for a leg down to 0.6779 and potentially much lower. But if that level holds, and I suspect it will for a tactical bounce, the pain trade is a sharp squeeze back towards 0.6979. The herd is overwhelmingly short. I'm looking at speculative positioning data, and retail sentiment is more than 70% short. That kind of one-sided crowd is the fuel for a vicious short covering rally. Institutions love to run stops just below obvious support before the real move. And I'll show you exactly where those stops sit. Let's walk through the technical landscape from the top down. On the weekly chart, the trend is a strong sell. The weekly candle is heavy, with lower highs and lower lows, and the MACD is in bearish acceleration mode. But here's the critical nuance. The monthly trend remains a buy. The monthly chart shows a long-term uptrend line that has held since the 2020 lows, and that trend line currently sweeps right through the 0.6780 handle. So what we have is a classic correction within a bull market. The weekly sell is pulling price into the monthly support zone, and that zone is now colliding with the daily 200-day moving average at 0.6895. This is why I'm not blindly piling into shorts. I'm waiting for a resolution. On the daily chart, the picture is undeniably bearish. We have a death cross formation with the 50-day moving average at 0.7080 slicing below the 100-day at 0.7026. The 20-day moving average at 0.7037 is accelerating away from price, acting as a descending ceiling. The MACD is negative, printing minus 0.005, and the histogram is still expanding lower, showing no bullish crossover yet. But look at the RSI. The daily RSI is 26.68. That is deeply oversold territory. The CCI is at minus 285. One of the most extreme readings I've seen in months. The Williams %R is nailed at minus 94.66. These are screaming that the rubber band is stretched to its limit. When you have a strong trend sitting on the 200 MA with this kind of oversold condition, you do not chase the breakdown. You anticipate a violent snap. Now drop down to the 4-hour chart, and this is where the hidden divergence gets interesting. Price has made a lower low, touching 0.6880 earlier, but the MACD histogram on the 4-hour has started printing higher lows. That is hidden bullish divergence, a classic signal that selling momentum is exhausted behind the scenes, even as price probes lower. The 4-hour 200 exponential moving average sits around 0.6940 and is sloping down, acting as dynamic resistance. The ADX on the 4-hour is 55, which confirms a ferocious trend. But when ADX gets this high, trends are often near an exhaustion point. The 60-minute chart is also strongly bearish. The 20-period moving average is below the 60, price is below both, and every bounce attempt has been sold into. However, the 60-minute RSI has carved out a bullish divergence against price, and the stochastic is coiled near 43, ready to turn higher. Here's what most traders miss. When the 200-day moving average is breached on the 60-minute but not confirmed on the daily, you often get a stop run. I expect one more flush below 0.6880 to trigger sell stop orders, and then a reversal that leaves a long wick on the daily candle. That wick will be the liquidity grab, and that's where I want to be a buyer for a counter-trend bounce. The precise support and resistance levels are non-negotiable. Support 1 is 0.6879, which is today's S1 and coincides with the 200 MA. That's the floor. Support 2 is 0.6843, a prior demand zone from 3 weeks ago. Support 3 is 0.6779, the structural low and the monthly trendline touchpoint. On the resistance side, R1 is 0.6979, the pivot point and the 50% retracement of the recent drop. R2 is 0.7043, the top of the order block where sellers will reload. R3 is 0.7079, above which the daily trend would shift. Watch these levels like a hawk. Now, let's connect the dots to the fundamental drivers. The 24-hour news headline is BofA warning that the Australian dollar stock is at a crossroads amid headwinds. That's not just a stock call, it's a macro call on the entire Aussie complex. What are those headwinds? Iron ore prices have been sliding, down another 2% overnight, and the Chinese property sector is still leaking. The RBA kept rates steady at 4.35%, but the market is pricing in a 60% probability of a cut by year-end. The yield differential between Australian 10-year bonds and US 10 years has compressed to the narrowest in months. That's a strong USD tailwind. On top of that, risk sentiment has soured. The S&P 500 dropped overnight, the VIX ticked up, and that has sent the Asia proxy, the Australian dollar, into a tailspin. However, what's priced in matters more than the news. The market has already fully discounted a dovish RBA tilt. If we get even a whisper of hawkishness from the RBA minutes this week, the short base gets obliterated. Conversely, if core PCE data tomorrow comes in hot, the US dollar could smash through 105 and drag Australian dollar to US dollar through the 200 MA like it's not even there. So my 1 to 2 week directional lean is this: a tactical bounce to 0.6970 to 0.6990 area, driven by oversold conditions and a lack of fresh bearish catalysts, followed by a resumption of the downtrend towards 0.6780. Invalidation for that view is a daily close above 0.7043. If that happens, the bearish structure is broken and I flip to neutral, looking for longs. I want you to engage right here. Do you think the dollar breaks 105 this week? Comment yes or no below. I'm tracking consensus, and it's a key input into my sentiment gauge. Now, the section that most people skip, but this is exactly where the money is made. I'm going to lay out 3 trade strategies, each with precise entries, stops, targets, and the exact conditions that void the setup. Keep watching, because the on-screen graphics will have these levels frozen for you to screenshot. Strategy 1, the sniper, conservative. This is my high probability fade trade for a bounce. The entry trigger is a buy limit at 0.6880. I want to catch the stop run just below the 200 MA support cluster. I need confirmation in the form of a 1-hour bullish engulfing candle closing above 0.6890 after a false break lower. The stop loss goes at 0.6855, which is below the S2. Pivot support and below the lowest point of the expected wick. That's a 25 pip risk. Take profit 1 is 0.6930, just ahead of the 4-hour 200 EMA. Take profit 2 is 0.6965. Which is the 5-period moving average and a prior minor resistance. The risk-reward ratio on this trade is 1 to 2 initially, and up to 1 to 3.4 if both targets hit. The setup is void if we get a 4-hour close below 0.6843. That would signal the 200 MA has definitively failed, and I will cut the long idea instantly and flip to looking for shorts. Right now, put this on your chart for sniper, conservative, entry, 0.6880, limit, with 1H close above 0.6890, stop loss, 0.6855 take profit 1, 0.6930 take profit 2, 0.6965 risk, reward, 1:3.4 are invalidation, Void if 4H candle closes below 0.6843. Strategy 2. The active trader, standard. This one is for those who want to trade with the trend but refuse to chase at the bottom. The entry is a sell limit at 0.6945. This is the pivot point zone, and it's right where the 4-hour 200 EMA and the 50% retracement of the latest leg down align. I want to see a bearish rejection candle on the 1-hour chart at that level, ideally an engulfing or a shooting star with a long upper wick. Stop loss goes at 0.6985, just above a 1 and the swing high resistance. That's a 40 pip risk. Take profit 1 is 0.6890, the 200 MA test area, for a quick 55 pips. Take profit 2 is 0.6845, the S2 zone, for an 100 pip gain. The risk reward on this is roughly 1 to 1.4 on the first target and 1 to 2.5 on the second. Once price hits target 1, I move the stop to break even and let the runner target the S2. This trade is void if price manages a daily close above 0.6990, because that would signal short-term momentum has shifted, and we could be in for a larger correction. Type your Australian dollar to US dollar range for tomorrow in the comments now. I want to see who's aligned. I'm reading every line. The active trader, standard, entry, 0.6945, sell limit, 1H bearish rejection, stop loss, 0.6985 take profit 1, 0.6890 take profit 2, 0.6845 risk, reward, 1:2.5 are invalidation, void if daily close above 0.6990. Strategy 3, the aggressor, high risk. This is a pure momentum breakdown play. If and only if price breaks below 0.6870 on the 15-minute chart and then retests it as resistance with a small-botted candle, I will enter a sell stop at 0.6865. This is a play for a cascade into S3. The stop loss is extremely tight at 0.6895, just above the reclaimed 200 MA, risking 30 pips. Take profit 1 is 0.6840, just above S2, and take profit 2 is 0.6780, just above S3. The risk reward is attractive at 1 to 2 on the first target and 1 to 5 on the second, but the probability is lower because of the heavy oversold condition. This trade is only for those who can lose small and manage risk aggressively. If price gets back above 0.6905 after the entry, the breakdown was fake and you exit immediately. I will repeat. This is a high-risk knife catch in the direction of the trend but against the deep oversold readings. I personally will scale into this with a fraction of my normal size to the aggressor, high-risk, entry, 0.6865, sell stop, after 15 minutes break a retest of 0.6870, stop loss, 0.6895 take profit 1, 0.6840 take profit 2, 0.6780 risk, reward, 1:5 are invalidation, void if 15-minute close above 0.6905 quick pulse on risk management. Never risk more than 1 to 2% of your account per trade. No positions through high-impact news like USPCE. Stops are non-negotiable. Hard stops, in the market, every single time. This is how you survive to trade the next big move. The Aussie will be here tomorrow, but only if your account is. Let's wrap this up with the single most critical level for the next session. 0.6895, the 200-day moving average. Tomorrow, all eyes are on the US core PCE inflation print. That number will either validate the dollar bid and smash the 200 MA, sending Australian dollar to US dollar to 0.6779, or it will come in soft, cause a dollar sell-off, and ignite the short squeeze I've mapped out. I'll be covering that cross-asset fallout in the Bitcoin video, where I'm connecting the S&P 500 divergence to crypto liquidity grabs. That video is live now. Tap the end screen. If this breakdown gave you a clear plan, smash like, subscribe, hit the bell, and I'll see you in the next one. This is Alpha Market Meridian, calling the trade before it happens.